It all starts with an idea, a rumor. Perhaps you heard someone at the water cooler said Snowflake is going public next week. You scramble back to your computer. You don't want to miss out. The feeling of FOMO is real. You jump on CNBC and Google and try to find out as much as you can about the company. You jump on YouTube and listen to the so-called IPO experts with millions of dollars on the line give you their biased opinion. But wait, you're forgetting the most important opinion of all, yours. What is your motivation? What is it that you want from this IPO? Do you want to buy and sell to make a quick buck? Or are you really interested in these companies and what they have to offer? Do you really want to learn as much as you can about them and what they do? Perhaps if you did, you will want to hold them for the long run. Google IPO back on August 19, 2004 for $85 per share. If you would have bought 10 shares of Google at $85 per share and held on to them until today, your original $850 investment will be worth over $15,000 today. So I ask you again, what is your motivation? In this video, I will go over how to properly conduct an IPO analysis for you to use as an IPO guide in the future, whenever you are thinking about investing into IPO stocks. Here, I will explain the IPO process and the things you need to look for. Let's begin by asking the most important question of all. What is an IPO? An IPO is an initial public offering. It's when companies offer to sell shares to the public in one of the two major stock exchanges, the New York Stock Exchange, founded in 1790, or the NASDAQ, which was founded in 1971 to deal with the large electronic-based trading. By buying shares of the company, the public becomes part owner of such a company and is eligible to receive part of the company's profits in the form of dividends. Although many new companies are non-profitable when they first IPO, which brings me to my next question. Why do most companies IPO? There are many advantages and disadvantages of IPOs. Let's start with the advantages. Because of the buzz, IPOs are an easy way to generate capital. This capital can be used to pay down debt and grow the business. Another pro of IPOs is that the company can come out from obscurity, acquire new customers, and join the elite group of companies who have IPO'd before them and now can say they are publicly traded. The biggest con is that now the company's finances must be revealed to the Security Exchange Commission, or SEC, via Form S-1, in accordance with the Security Exchange Act of 1934. This act protects investors like you and I from fraud. Every time there's a significant change in the company's finances or leadership, the company must file documents like the 10-Qs and the 8-Ks with the SEC. There are costs involved with these filings that the company must consider before IPO. Companies apply for IPOs by completing a Form S-1 with the SEC. The form contains a letter from the CEO, a prospectus summary outlining the company's mission, overview, background, and how the proceeds from the IPO will be used. It also contains the company's capitalization and consolidated financial data that outlines the company's debt, equity, revenue, and net income. This is what you as an investor should be looking for and pay attention to, as well as the CEOs and other executives' compensation. After reviewing the Form S-1, the SEC decides if the company is ready to go public or not. The entire S-1 should be read carefully and analyzed by every investor with the help of a professional or financial advisor before investing into any company's IPO. If the company filed a public Form S-1, it can be found by simply doing a Google search or at the company's website under SEC filings. Companies often choose to file confidentially for an IPO. In this case, the S-1 will be available only and after the SEC has approved the IPO. Upon SEC approval, the company is now able to IPO on a specific date and time of their choosing. The company then selects a group of banks to serve as underwriters for the company. These banks then sell company shares to the public. Underwriters set an initial price per share. However, depending on the demand and the volume, the price of these shares could fluctuate significantly before, during, and after the IPO date. Because you did your due diligence, you now know how much you are willing to pay per share and what is considered a fair price. Many IPO investors are investing and paying for future gains and betting on the company's ability to grow and potential in the future. During IPOs, many companies choose to have lockup periods. During this time, major shareholders like industrial investors and insiders are not able to sell their shares to the public. Many public investors choose to wait until the lockup periods are over and more shares are available in the market before investing. These lockup periods could last anywhere from 90 to 180 days after the IPO. Investors looking to purchase fractional shares during IPOs will also notice that some companies will allow you to do so and some won't. That is up to the underwriters and the brokers. Those looking to trade options will also have to wait at least 5 trading days after the IPO before trading options. So you did your research and you found out everything you can about the company. You read the S-1, you looked at the company's website, you believe in their product, and you're ready to start investing. So how do you go about it? Well, the next step is to choose a broker. I use Robinhood because it's free and I'm able to search for the ticker symbol first thing in the morning of the IPO. When I find the ticker symbol, I'm able to put in my bid and let Robinhood know the most I'm willing to pay per share. If the company comes in at a lower price, then my limit order is normally filled by noon. If not, then I will check back on Robinhood around noon and adjust my bidding accordingly. There are other brokers out there you can use like Fidelity to buy into IPOs. But if you would like to use Robinhood like I do, there's an affiliate link in the description. IPOs are not the only way companies can go public. You also have SPACs and direct public offerings or DPOs. SPACs are special purpose acquisitions companies and happen when sponsors or other investors come together to raise capital to acquire a private company or companies. If you want to learn more about SPACs, please visit the SPAC King of YouTube, JMac Investing, where he can answer all of your SPAC questions. Link in the description. But today, I'm going to cover the difference between IPOs and direct listings quickly. With IPOs, the company pays underwriters to sell their shares. If the company wants to sell direct to the public, and not use any underwriters, they can choose to DPO. With DPOs, companies can avoid lockup periods and save money. The only downfall is that there's no guarantee that the public will buy any number of shares from the company. With traditional IPOs, the banks have already purchased a number of shares to be sold. I hope this video helped you better understand IPOs and how to invest in them. If it did, do me a favor. Drop a like, subscribe to the channel, and support us on Patron. Until next time, guys, make sure you take care of yourselves, and I'll see you soon.